Hello, dividend growth stock investors. It's Colby, the DGI Crab here, and I'm wanting to wish all of you a very happy Thursday. I hope that your investing week is going just swimmingly, that you've gotten all of the purchases done that you wanted to make for the week, or if you've still got a little money sitting over there on the side to spend tomorrow, thinking that you're going to find a deal. I wish you the best, and I hope that you find exactly what you want while you're shopping for that sweet, sweet passive income that those dividends will provide. So, guys, I am not going to be investing in the S&P 500 anymore between now and the end of the year. There's not going to be any VOO and chill for this investor, for this DGI crab. And you might be wondering, why in the world would you stop investing in the S&P 500? Even as a dividend growth stock investor, isn't the S&P 500 worth having in your portfolio? Well, I'm going to dive into my reasonings why I'm going to be making a bit of a strategic shift. I hope you are going to hold along for the ride. So, for those of you who are new, this is a unique dividend growth stock investing channel in that I only am focused on acquiring a group of 60 dividend growth stocks as well as some ETFs for automatic diversification. And of those 60 stocks, they're split into four separate categories or tiers based on the age and time horizon of the investor, which I think is the most important metric that any dividend growth stock investor should take into consideration. What is your timeline to retirement? Are you still in your younger years and you're just getting that portfolio really up and running? Well, for you all, in my opinion, you want to get lower yield stuff with aggressive dividend growth because you're going to hold those positions for the long haul. You want to have those 10% or better dividend increases snowballing for multiple decades. And if you're an older investor, you're up there in your 50s, you're nearing financial freedom, you're just acquiring some stuff here towards the end of your working career to get you over the top, well, you probably want to get some stuff with a higher starting yield because you don't have as many decades left for those big dividend increases. So I'm putting half of my money into age appropriate ETFs each and every week. And I've been doing that with VOO. That's one of the ETFs that I am adding to each and every week, but I won't be for much longer. Now, there are plenty of reasons to love the S&P 500 or specifically VOO, the Vanguard version of that. The Vanguard version has a low expense ratio, and the S&P 500 on average returns about 11% a year, and that has more than a century of history behind it. The VOO or the S&P 500, it does pay a dividend and it does stably grow over the long haul. It's not a great dividend themed investment. The starting yield is low. The dividend yield growth isn't incredible because it's not a dividend themed fund, it's a market cap fund. So the dividends aren't going to like clockwork increase every year, but over the long haul, they do typically tend to go up more than they go down year over year. And the S&P 500, it's getting me exposure to excellent companies that don't pay a dividend, stuff like Berkshire Hathaway, Amazon, Tesla, Nvidia, technically with an asterisk there, just to name a few. And as a dividend growth stock investor, I'm not purchasing any individual single stocks that don't pay out a dividend. And right now, because I don't have enough history built up yet and the yields are so darn small, that even the big name tech players that have jumped into the dividend space, like Google and Meta, Booking Holdings, they're just not paying out much of a dividend right now to speak of, and I don't know if they're going to grow it very quickly. So I don't buy that stuff either. So VOO is giving me exposure to those companies, so I'm not going to have any fear of missing out on some of that growth potential. So the reasons for deprioritizing VOO, well, you could kind of flip some of those, those first couple. The dividend yield, as I said, is low. Starting out, you're going to get anywhere from 1.15 to 1.45% as it stands right now. And as I said, that dividend growth is slow. The average you could count on year over year is probably going to fall between 5 and 6% on the dividend increases. And that's not going to be stable. Some years, just like the growth, it might be a lot better than that. Some years it might be worse or even go down, depending on which companies have left the S&P 500, which ones have entered into the S&P 500 when those funds get rebalanced. And the exposure to those non dividend paying companies, well, it's not really a pure investment from a dividend growth perspective. There's some folks out there that don't want to own anything unless it's paying some sort of a dividend. And with the S&P 500, well, you're definitely going to get exposure to plenty of companies that don't pay anything out at all. But the main reason why, you guys, is I am graduating to a new tier. That is the main reason why I am going to pause or basically stop moving forward investing more into VOO. Because I'm going to graduate from tier 2, which is a 31 to 41-year-old investor in my estimation, to a tier 3, the 42 to 53-year-old investors. I'm going to turn 42 on November, and therefore I'm going to shift my focus, my new money I'm adding to the portfolio, away from VOO and into some higher yielding investments starting out. So who is VOO best for if it's not any longer great for me personally? Well, first of all, it's best for young investors who are just starting out, especially if you haven't even hit age 40 yet. Especially even if you haven't hit 30. The more years that you have before you hit 40 years old in front of you, the better of an investment the S&P 500 is going to be. Is that 11% on average growth on the share price? When you're in this thing for the long haul, that can make a big difference. It's also good for investors who just want to set it and forget it. Look, you guys know it out there. There's a lot of people out there just don't want to deal with investing or this finance stuff. They know that they should be investing in something, but they aren't going to have any love or appreciation for researching different stocks or ETFs. They just know they should be investing their money in something. So if they don't want to worry about where to put it, the S&P 500 is arguably the best thing to just dollar cost average into, especially if you are under the age of 40. And then for the long-term retirement investing, your 401k, your Roth IRA, the S&P 500 is the largest individual holding that I have in my 401k pretty comfortably. And while I don't own any S&P 500 in my Roth IRA, I do hold some SCHG because I want to get some great share price growth over the long haul. I own a lot of VIG as well, which is also a lower dividend yield play. But that's just because I know no matter what, I'm not going to touch any of those funds until at least 59 and a half. So I've got plenty of time to enjoy the growth on those, and I'm not constantly shifting around what I own in those. And then finally, the long-term major purchased savings, VOO for S&P 500, but I'm going to just go VOO with this. Not a bad place for long-term savings. So what do I mean by that? Well, let's say that maybe you just bought a car and you want to start saving for the next car, so that way that years from now when it's time to swap that thing out for something else, you're going to have the money there. Well, if you bought a car, hopefully you're going to get it minimum, depending on how old it is, I don't depending on the quality you're getting, you're at least going to want to get a few years out of that car. And if it's a particularly newer car with not a lot of miles on it, then maybe even longer than that, 5, 6, 7 years, you'll want to have a hold of that thing. So, why not start investing a little bit of money every month into the S&P 500 right now? You're not thinking about making any purchases with that money within the next 12 months. So even if the stock market goes down in the short term, your time horizon is long enough that the S&P 500 returns are going to be a lot better for you than if you just had that money sitting in a CD or a high interest savings account, something like that. I think about 18 months out from the purchase in question, whether it's a car, down payment for a house, if you're a first time home buyer, those big purchases, those are the main two I could think of offhand that you're going to be working toward that purchase for quite a long time, at least 18 months. S&P 500 is a pretty nice place for that. You know that eventually, a few years from now, you're going to make one big withdrawal to handle a major purchase, and you want to get a better rate of return than a savings account. I think it could be a pretty good use of your energy there. So let's just hop over to the spreadsheet here to close things out here, you guys, and look at the different tiers. So my investment strategy, as I said at the top, half of my money at minimum each and every week that I invest in that brokerage account is going into age appropriate ETFs. The other half goes into stocks within the particular tier that I'm in. So I'm in tier 2, which is how I've been focusing now for quite a few years. My primary allocation goes into VIG, the Vanguard Dividend Appreciation ETF, because I feel like of all the ETFs out there that are dividend focused, this one, while it may not be the highest dividend increase every single year, SCHD has outdone it several times. DGRO at times does a little bit better. But VIG, I think over the long haul, is going to be the most consistent with their dividend increases year over year because of how they're selecting the stocks in that fund. Usually it's like 1.7, 1.8% starting yield, but with the dividend growth rate, we're hoping to get between 8 to 12% year in and year out on that growth rate. So that's been the primary focus. And then I've been adding VOO at a 15% clip, along with VBR, a small cap value ETF. So those two combined are making up 20% of my new invested dollars every single week. But moving over into tier 3, I'm going to be completely replacing not only VOO, but also VIG and VBR in favor of some ETFs that have a higher starting yield. So as it stands right now, if I was making that switch over today, my new money allocation would be 25% into SCHD, 15% to VYM, and 5% to DHS. So this is going to be how I start allocating my new invested capital going forward. Now you might be asking, since I'm not investing in VOO anymore, do I plan on cashing out of VOO and moving those proceeds into something like SCHD that pays a higher starting yield so I could get an immediate dividend increase? And the answer to that for right now anyway is no. I don't intend on doing anything with my current position in VOO. When I stop adding new money to it, I am at least through the age of 45. My plan is to not only keep the VOO in hopes that I continue to see consistent share price growth, but I'm also going to keep the dividend reinvestment turned on for VOO at minimum through the age of 45. I want those dividends to continue hitting that investment every 3 months and continue to allow it to grow more and more over time. Now, as I get past the age of 45, every year that goes on from there, depending on what's going on with my professional working life, what's going on with the portfolio, how close am I to being able to retire off of my dividends, how big of a hurry am I in at that point in time to retire off of those dividends? That will be a big decision for later on in my 40s, because I could see at that point maybe stopping the dividend reinvestment on VOO and then taking the dividend payout from VOO and maybe VBR as well at that point, and just starting to put that money into the tier 3 ETFs. Or even if I'm at that point in my late 40s where I've got enough money and dividends coming in that I don't really need to work anymore, I don't really need to even reallocate anything to higher yielding stuff, I could see on some occasions continuing to reinvest all of my dividends, but living off of the dividend payouts from VOO, just taking that cash and living off of that for a little while. So it really kind of depends, but I have that ability later on in retirement to either move the VOO money into higher yielding stuff like SCHD, or even into some of the tier 4 stuff like SPYI. Get that S&P 500 with the covered call overlay to turn that growth into monthly dividends. All of that is just kind of wait and see for me. I've got several more years before I really start thinking about whether or not I want to start reallocating some VOO. But I've got just a few months left in my own strategy, and then it'll be time to say goodbye to adding new investment dollars to that VOO position. Let me know what you guys think down in the comments. Am I right on here? Am I making a mistake? I'd love your feedback. Until next time.